Well, yesterday we talked about the fact that I thought that there was a huge problem because of the infinite return strategy, which has been carried out by an awful lot of investors across the country. And I've had an awful lot of people call me and ask me to elaborate on this. So let's just talk about this. This is going to doom the banks, the pension funds, the insurance companies, all the big lenders are going to take losses. And I'm going to tell you, they're almost guaranteed to do this. And there's a couple of reasons why. Now let's just talk about what we're talking about here. So if we go back to the great financial crisis, one of the reasons and one of the culprits for having defaults across the country was that people had used their homes for ATMs. They had withdrawn all the equity out of their properties. They did credit lines, they did home equity lines, and they bought motor homes and vacations and new cars and remodeled. And they just had a great life, taking the money and the equity out of their properties. And then, of course, once they had a downturn in the economy and we had a little bit of deflation, which is what I think we're going to be getting, well, then they went underwater. And of course, there wasn't any value left in their property. They extracted all of their equity and they gave the properties back to the banks. And the banks had all the risk and they took enormous losses. So now when you talk about an investor is using the infinite returns strategy, which means that if they buy a property for $10 million, they put $3 million down. Then they go in and they landscape, they paint, they clean the properties up, they put in new lighting, they change out the appliances, they change out the flooring. They make the properties look really, really nice. They raise the rents, and then they go to refinance the property. And instead of it being $10 million, it's now $14 million. 30%, they take out a little over $1 million. So they have all their money out of the property. And the risk has now been transferred to the lender because the investors have all their capital out. So everything they make from there on is infinite returns because they have nothing left in the property. Now, they can do this several times. So in the last 7 or 8 years, we've had zero interest rates, or almost zero interest rates for bonds and treasuries, and of course 2, 3, 4% for big projects. And of course, this makes cash flow easy, makes valuations very, very easy to achieve. And so this goes on and on and on. So when you have an appreciating market where you have 10 or 15% appreciation, and remember in 21, I think we were looking at 25, 30%, 35% here in Phoenix, which is crazy stuff. Look at that for an apartment building. So you have a 30% appreciation in 1 year. Well, they can do it again. So they can get 30%. They get the property appraised at 70% loan to value, and they extract some more cash. So now they've had a lot of money. So if they went from $14 million to $18 million, and now get a mortgage for $14 million, they can take $2, $3, $4 million out of that property, and they can do that 3 or 4 times. But then they eventually reach a ceiling where the properties no longer work, which is what's going on now. That's why we have a lag effect, because unless you're refinancing, there's no real reason. You're still you're just enjoying the mortgage. But as soon as that mortgage comes up for refinance, because remember, they're 5, 7, or 10 years, they come up against that refinance wall, they'll give the properties back. And who gets those is the banks, the pension funds, and insurance companies. These are the ones that fund most of the really, really big projects. So if you've got a 40-story tower, probably a mixture of these three. And it's not just the big banks, because the big banks typically don't do that. This is local banks and regional banks. And they're the ones that haven't done enough for their risk management on these things. So let me go to my next slide. Let's just talk about this. I don't want to make this a long video. I would like to get your comments. Oh, by the way, if you like our videos, it really helps if you subscribe and like these things. YouTube just thinks this is great. We'd like to get a little more marketing. So if you could do that, that'd be great for us. So now, we've been talking about the fact that we use timing models. Timing models keep going back year over year after year. For 100, 200, 300 years, we have this 18-year cycle coming across. Now, remember, it's a real estate cycle. It's not a housing cycle. It's a real estate cycle. And like in the 80s, the problem is starting in the commercial space. It will go to housing, because we're going to have deflation. All this liquidity that was into the economy is going to get taken out. And of course, when you put liquidity into a building and you take a $300 million loss on a building, well, there's $300 million worth of liquidity that now is destroyed. So we're looking at a timing model that's rolling over. Now, it's not a time and space. It is a process. So it's a period in time, and we are in that period now. It is going to give us enormous opportunities. So those that are still standing when this finishes are going to be able to make an absolute fortune. Generational fortunes are going to be made. You just have to have your cash, your income, and your credit. Excuse me. Let's go to the next slide. Let's just talk about what's going on. So this happened. I've used this slide many, many times because it is just so telling. Do you see the liquidity bubble? So when we got into this COVID problem, no one knew exactly what we're looking at, and the economy just failed. It just stopped. So in order to start it, they put about $5 trillion into the U.S. in the economy, U.S. economy in about 6 months. I think it was a lot more than that because all the central banks around the world did this, and this money just went into the economy, and we just had it just flooded the economy with fuel. And of course, the banks, they've got all this money. Does them absolutely no good unless they get out in loans. So they were willing to put it out in all kinds of crazy stuff. They just wanted to get the money out, and of course they get paid every time they do a loan. They get paid. Lenders get paid, the loan officers get paid, the title people get paid, appraisers get paid. A lot of money goes into the economy only when you refinance. So if you're not refinancing, this is the lag effect. Now you can see the liquidity bubble. And of course, we got to March of 2022 and it peaked. That's when the Federal Reserve started withdrawing $100 billion a month or over $1 trillion a year and slowing the economy down. We recognized that in our business. We knew that there's no more new capital going on. We stopped. And you can see what happened. Now, when you come on to the right side where it says bust, the economy was really, really slowing down in 2022, went into 2023, and right on schedule, we had banks go bad. Just one of the signposts for when the real estate cycle starts to roll over, banks start going bad. Silicon Valley Bank went bad, Signature Republic. And of course, the Swiss Credit Suisse Bank, which is a systemically important bank, went bad right on schedule. What's the policy response? They put in $500 billion into the economy, and we get a big pop. And of course, the real estate reacted to that. So we had a fairly good 2023 from that. Same with the stock market. Stock market had a really, really good year from that because of this liquidity that went in. It's coming out now. So we're going into that bust cycle. And once you go into the bust cycle, this is where things really start to happen. So we have infinite returns and bad risk management. Now, I'm telling you that the banks, any of the lenders, and of course, pension funds are big lenders because they need to get a 4.5%. They have a 4.5% burn rate. So they have to get at least 4.5% cash flow just to replace the money that they're burning. So they're always looking to do this. So you've got pension funds and insurance companies, same thing. They need to be earning income all the time so that they can pay their claims. They're the big lenders for these big properties. And oftentimes you get a mixture of these. So this happens. This is just a strategy done by professional property and portfolio managers. They take the money out of the building and they take all their cash. They're transferring that risk from themselves to the lender because they have nothing left in the property. So once you do an infinite return, whatever you get beyond that, if you have zero and you get 100, that's that's an enormous return. And you can do that. And of course, they're safe. Now they've taken all their money. So they're playing with the house's money. It's like you're gambling and you've had a really big pot. You take your seed money out of the pot, and now you're playing on house money. So the house money is taking all the risk. If you lose all the house money and you still have yours, you had a lot of fun for the night. And they've transferred the risk from the investors to the lenders. Now let's put that on top of the fact of risk management for when they did the reserves and bought the reserves, thinking they were being very, very conservative in buying long-term treasuries and having risk just wipe them out when interest rates go up. Because rising interest rates are really, really bad for a fixed rate portfolio. So a lot of these lenders and the banks, their portfolio. This is what really happened, I think, to Silicon Valley Bank. They got caught with the fact that their reserves were in bonds, and of course, when the bond market takes a huge hit, I mean, they've had the worst bond market since the Civil War. So that's that's a really long time, and they lost 40-50%. Well, this destabilizes the banks. But I'm going to tell you that the infinite returns is what's going to take out the local banks, and it's going to take out the regional banks. So let me just go to my next slide. Let's just talk about what they're doing right now so that you can recognize this. I've used this slide before. I got this from Zero Hedge. We're talking about the commercial banks that have unrealized losses of $600 billion. Well, I have to tell you, they're probably way more than $600 billion. I think they're just talking about the reserves here. And it's 10 times what they had in the great financial crisis. That's now. They haven't realized these losses, but they're going to. Let me go to my next slide. You can see what's even worse is that the Federal Reserve put out a lifeline to them called the Bank Term Funding Program, and it can go in and borrow money to give them liquidity. So if you're a small bank or regional bank and you're having problems, you can go into the Federal Reserve and borrow money. And that program is coming to an end in March. So that's only 6 weeks away. And when that ends, we're going to find out who's really in trouble and who's really not. But I think this is going to be a widespread problem. But again, if you're an investor and you bought into a multifamily and you're not refinancing, well, you're just fine. This is the lag effect. You're only going to run into trouble when you go to refinance and that building goes from being viable to not being viable. When interest rates go from 3% to 6 or 7 or 8%, and your debt service takes up all that available cash, well, the property is no longer viable. And when you go to refinance, the value of the property comes down and it wipes out your equity position. But it's really not your equity position because you have all your cash out of it. So yes, you lose your profit, but you're like the gambler that's playing on house money. You give back the house's money, you still have your money enough to play again. This is what's going on. I think this is going to doom the banks. I think they're going to take an enormous loss. So if you'd like to know what's going on, if you'd like to make some plans, because we are going to make an absolute fortune when this runs its course, and it is going to run its course. So let's make no mistake about it. This is going to happen. It's underway right now. It's starting in the commercial. It will eventually go to housing, but it's going to really dampen the damage is going to be done in the commercial space. When that happens, there's going to be deflation because there's going to be default. You're going to see the prices of these properties drop like a rock. And of course, we have a huge housing shortage here in the country. But the problem is it's a problem of affordability shortage. So we're building all kinds of buildings, but no one can afford at the moment. So they're going to sit vacant until they become affordable. And how will they become affordable? Well, they're going to become affordable when they default. And here's one other thing for you to keep in mind. We're talking about 1.7 or 8 million houses that are under construction right now. Only 10% of them are pre-sold. It means there's like 1.5 million specs coming. That's the builders trying to get out of their land bank, because they have a lot of land. And the only way you get out of a land bank that costs you money, because you got to pay on that, is to build it out. What happens when the banks that you're doing business with start taking losses and they can no longer extend credit? These builders are going to be in big trouble. So we have problems coming. Those problems are going to give us tremendous opportunity for those that are still able to do it. If you'd like to take advantage with us, we are waiting. We're already looking at making some very big moves. We're trying to get a pile of money put together. And if you would like to consult with us, see where you can fit in, where we can fit into your plans, give us a call. My best to you guys. Bye-bye now.